All right, good evening. Okay, we'll get started for today's sharing over here. Now, today's sharing is going to be very important, and we can't find a much better time to really talk about this topic. In line with what has just happened recently, for the month of January since we just started. Yeah. So very quickly, just wanted to. I know I'm not sure how many of you are active in the equities market, right? So there's a slight difference in terms of the nature of like forex as well as stocks, right? Because in terms of like equities market, it's not gonna be like range most of the time. General direction for S&P, for example, is usually if you stretch it long enough, it's always gonna go up, right? But in terms of FX, we do have like range bound environment. Nothing is gonna continuously going up. So there's a slight difference between that, right? So when there is a significant drop in the equities market, that's where a lot of people are going to be fearful, worried, anxious, right? And this is exactly what happened since the start of this year, right? So if you take a look at, just this a very quick rough measurement, you can see where we are right now. Okay, from the start of the year in 2022 all the way until where we were, yes, as of yesterday, the market has dropped 9%, right, or 9+%. Okay, and that causes a lot of panic and fear. Okay, and that's why I say like there's no much better time than to talk about trading and investing psychology and emotions for today's topic over here. Okay, so yeah, so let's go into what we want to cover for today. Okay, which is the main idea here is to share with you, why is psychology so important, and some little techniques over here to actually help you manage this better. Okay, now psychology, while it's not a very, I would say, interesting and attractive topic to many traders and investors, it's no doubt one of the most important element towards successful trading. Okay, just to illustrate, why psychology and emotional management is important, because a similar strategy given to two different traders, right? One who is able to manage the trade, manage the psychology, and the other one has absolutely no idea about psychology. Uh, the outcome and the performance of that is going to be very different. Okay, I think you guys who have been trading for some time would know what I mean. Okay, so that's actually the importance of psychology. Okay, a similar strategy, a profitable strategy, does not equal to positive result if you are lacking the management psychology. So over here, let me share with you a little bit in terms of how you can work on your psychology and your emotion towards trading and investing. Okay, of course, this is not going to be a one size fit all solution for everyone. Okay, but the idea over here is to at least give you the principle, the concepts which you can start to work on. Okay. Now, the first thing that all of us really need to define is to properly put in words, right? What is our definition of success? Now, of course, we're not talking about life success. We're not talking about, other aspects of success. But of course, over here, we're going to be focused on like success in terms of trading and investing. Okay. Now, it sounds no-brainer, right? A lot of people would say that, Kar Yong, that doesn't make sense at all because everyone comes into the market, of course, with the main idea of making money, okay? And the impression of trading investing is basically a money-making machine, right? Yes, okay, I agree with that, that every trader and investor that comes into the market, one of their objective is to make money, right? If today you enter the market not wanting to make money, then something's wrong with you, okay? But everyone wants that, right? So who doesn't? But what I want to highlight or stress upon here is that beyond just the monetary reason for you to join and be part of the market, okay, is what other reasons that made you want to trade. Okay, now this little exercise, while it's simple, it's very important that you put into practice. Okay, when I mean that is, you might want to allocate, a good 30 minutes of your time, maybe after this sharing. Okay, take a piece of paper, take a pen, and write this exercise down, right? So basically, write down like, how do you define success in trading? Okay, what's the reason other than monetary that you want to trade? Okay, because if today your primary sole purpose of trading and investing is really to just simply make money, okay, I can assure you that there's so many other alternatives out there. Okay, you can start a side income, you can do online business, you can just maybe get a part-time job, things like that, right? There's so many alternatives that can provide you the monetary reason. Okay, so beyond that, why trading? Okay, so this is very important. Now, some of you might be starting to think, oh, okay, I don't need to write it down. I have the answer in my head. Okay, but I just want you to know, okay, there's a difference between you putting it into words by writing it down versus like, just thinking it inside your head. Okay, there's a huge difference between that. So I would strongly encourage that, you want to do that physically. Okay, write down your reason. It can be more than one, okay, but I would strongly encourage you to do that. Now, just give you some idea, right? Different people have different reasons to it. Perhaps some of the traders come in because of fame. Okay, fame meaning, it sounds cool. Like walking around the street, telling your friends, "Oh, I'm a trader, I'm an investor," right? It feels cool. Okay, so maybe that's one of the reason. Okay, nothing wrong about it, right? Or maybe is it enjoyment, right? Some of you maybe would enjoy the thrill, okay, of putting money at risk, right? It's just like almost borderline gambling kind of idea, right? Or perhaps is it the excitement, right? When you actually take a trade and then it becomes a winning trade, you feel very, very excited, okay? And you like that kind of adrenaline, okay? So there are many reasons, okay? These are just some ideas that most traders might have, okay? Now, this is important because when we talk about psychology, when we talk about emotional management, because all of us are different, okay? Now, without a proper clear reason and definition of like why you want to trade and what's the success to you, it's very difficult for you to then manage your psychology and your emotion because you are not yet aware of like why. Okay, so that's why I start off with having you to actually put this exercise in, okay, to define why, okay, why you want to trade, because that will give you some ideas, some clues as to what do you want to seek out from trading, okay, and how then can you better manage that aspect of it. Okay, so over here, as I say, right, if you don't know what you don't know, okay, you can't plan, you can't prepare. Okay, so that's why it's very crucial to at least take some time to write down how do you define success in trading, why do you want to trade and invest. Okay, so take some time to write it down. Okay, why do you want to trade, why do you want to be a trader? Okay, and I want you to focus on like beyond just monetary gain. Okay, because again, there's so many ways to make money. So why be a trader, why be an investor? Okay, so what do you want to benefit from the market, okay, other than just money? Okay, is it fame, is it name, is it credibility, is it time, freedom, is it the ability to trade anywhere? There's so many reasons, okay, and there's no right answer to it because everyone is different. Okay, and you also need to be clear in terms of like right now. Okay, of course, we're not talking about maybe 5 years down the road, but right now, do you want to be a part-time trader, full-time trader, taking trading and investing as a hobby? Okay, you need to be clear on that as well. Okay, and of course, to go deeper, we always ask like why. Okay, so if today your answer is, oh, I want to be a full-time trader, so why? Okay, so you need to ask yourself why, and then you need to find those answers out. Okay, and I strongly encourage you to do this exercise by writing the answer down. Okay, now that's the first part of it. Okay, once you have some clarity on that, okay, it gives you that empowerment to start managing and understanding your psychology way better. Now, with that set aside, the second step over here to talk about psychology is, of course, we need to address this topic called expectations. Okay. Now, a lot of times, especially for newer traders, right, when we hear about trading and investing, or when they want to join trading and investing, when they want to come into the market, okay, their expectation of the market is always, misproportion. Okay, what I mean by that is, I often hear traders say that, what, you only can make 15% per year. Okay, that's like so little. Okay, I heard, whatever fund or whatever trader is able to make 15% per month. Okay, now that's a huge difference. Okay, one is per year, one is per month. Okay, now the question you want to ask is, of course, having big goals, big dreams is great. Okay, but you need to also understand like what is the average successful trader doing, so that you have at least a benchmark, right? You have a proper expectation. Okay, now why is this important? Okay, because if today you have a mismatch of expectation between yourself and what the market is able to give you, you'll find the entire journey very challenging, right? And then your psychology, your emotions are going to be screwed up. Okay, now I'll give you an example. Okay, if today you're riding a bicycle and you want to chase, a vehicle, a car, okay, on the highway, right? That is beyond expectation, right? You can't do that. Okay, so if you put that perspective into trading, it's just like if today the market is just a vehicle like a bicycle, okay, and your expectation is like what, 150 kilometers per hour, right? There's no way you're gonna achieve that by riding the bicycle. There's no way the market is able to give you that kind of returns in normal circumstances. Okay, and because of that mismatch, right, you're gonna be constantly feeling like, how come I'm not able to achieve that? Okay, am I lousy? Okay, you start to second doubt yourself, you start to beat down yourself, and then your entire psychology is going to be affected. Okay, so today when we talk about psychology management, it's also very important for you to understand what the market is able to give you. Okay, of course, this is not like all the time, but at least understand the typical average expectation, right? Of course, there are some outliers in the market from time to time. Okay, so what is, I would say, the average market returns that you can expect from trading and investing? All right, so to give you a very rough statistics, okay, the average retail investors, which we're talking about, people like you and I, of course, some of us are, profitable, some of us are losing. The average retail investor, right? So if you put them together, we average out about like 3.8% annually. Now this number doesn't look very, very good. Okay, I mean, it's better than the interest that the bank pays you, but you're basically not really beating inflation, right? Especially last year inflation was 7%. But this is the stats. Okay, so in other words, if today you're able to make a performance, or generate a return of, let's say, more than 5% annually, okay, you're actually one of the top performing retail investor, right? So that is just a stat for you to reference a benchmark. Now, to put things into perspective, let's take a look at the average return of the US equities market, S&P. Okay, it averages about 8% annually. Of course, this is being stretched out in a long period, right? Because sometimes it can be like 10%, sometimes it can be 20+%, sometimes it can be in a negative, sometimes it can be zero. But if you average it out, it's about 8% annually. Okay, now again, if you're able to trade and invest and you're able to generate a return of, let's say, average 15%, okay, or even let's say 10% to 12% annually, you're actually beating the market. Okay, we're not talking about just 1 year, but we're talking about averages per year. Okay, so if you're talking about consistency over a period of time as well. Now, what about very successful and well-known investor, people like George Soros, people like Ray Dalio, people like Warren Buffett? Okay, now they are able to average about 30% annually. Of course, not every year they're generating 30%. Some years they might be doubling their account, their portfolio. Sometimes they can be below 10%. Sometimes can be around 30%. But you average out. Okay, that's about 30%. Now, so today, if you have an expectation, oh, I want to make 15% per month and therefore double my account in a year's time, you benchmark to what the market is doing, okay? And you ask yourself, okay, is it something that is doable in a consistent and sustainable manner, right? Likely not, okay? So this expectation to match what you want to get out from the market is crucial. Okay, just now as I mentioned, the analogy of like a vehicle. Okay, you can't jump onto a bicycle and expect to ride it at a speed of 100 kilometers per hour, right? But that's what you need to understand. Okay, so same thing in the market, you can't come into the market and expect to generate 15% return per month on a consistent basis, because the market can't give you that kind of return. Okay, so this one here, I'm not saying that you are capped at 30% annually. Okay, of course, There are traders who outperform that, but you need to have the clear understanding that it's not going to be every year. Okay, like for example, in 2020, my return on the equities market is 36%. Right, I beat even like the successful and well-known investor in the average yearly basis. Okay, but 2021 itself, it wasn't as great. Right, 2021 was what about 10+%. Okay, so not every year is going to be there, but you need to average out. Okay, so I hope that's clear so far. Okay, so you need to understand that in the market, it's always a balance, right? And it's always in a scale where if today you want a high return, you need to be prepared for a very high risk. Okay, so we have this term called high risk, high return. So if today you want to get like 15% per month, okay, is it doable? Yes, but you need to take massive amount of risk in order to achieve that. Okay, and when we mean massive amount of risk is that the potential of maybe blowing up your account, blowing up your portfolio, and you might potentially lose every capital that you have inside it. Okay. So it can be doable, but understand this logic in trading and investing, right? It's always about high risk, high return, low risk, therefore low return. Okay, so next up, you need to understand risk. Okay, so from knowing your why, having a better expectation of what the market can give you, you can start to a bit, manage your psychology a little bit. Now, the third aspect over here is to understand risk. Okay, because a lot of times, especially new traders, when we hear about trading and investing, the first reaction that they're gonna give is that, well, the market is risky. Okay, Bitcoin is risky, crypto is risky. Yeah, to a certain extent, it's true, right? But most of the time, when these traders say that whatever market is risky, it shows that they do not understand the market. Okay, now put things into perspective, right? If today, you have a kid, and the kid tries to play in the kitchen, what would you have in your mind? Oh, it's risky, it's dangerous, right? But if today it's not a kid, okay, it's an adult that goes to the kitchen, what will you think? Whoa, great, dinner is being served soon. Okay. So what changed? Okay, not the kitchen. The kitchen is basically the same. But what's different over here is one is a kid, one is an adult. Okay, so the same thing applies in the market. The market is the same, it doesn't change, right? But what's different is who is participating in the market. Okay? In other words, the market is not risky per se. Okay, in fact, everything has risk, right? Just like I mentioned, kitchen has risk, right? Today, if you want to drive on the road, there's risk. Okay, the key here is never to remove the risk, but to reduce it, or I would say, to acquire the ability to manage risk. That's the important aspect of it. Okay, so same thing in trading, right? The idea is once you understand the risk involved, once you acquire the ability to manage it accordingly, you significantly reduce the risk. Okay, and what's the worst case scenario in trading? Okay, to be very honest, if today you understand the risk of trading and investing, the worst case scenario is you're going to lose whatever amount that you put in. Okay, because if today you do proper risk management, you do proper leveraging, there's no risk other than losing money itself that you have put in place. Okay, so that's the worst case scenario, but of course you can even reduce that by doing a more stringent risk management approach where you don't even lose your entire capital. Okay, so the idea again, the market is not risky. Okay, what's risky is someone who doesn't know or doesn't understand risk enters the market and not manage it well. Okay, so I hope that helps, right? Clearing a little bit of all this aspect here can calm your psychology better. Now, once all those are set, okay, this is the part where I want to talk a little bit about your trading strategy, your trading methodology, or investing strategy, investing methodology. Okay. Now, there's this term here called expected value. Now, it's not a very common term because most retail traders, they only talk about what's your probability, what's your win rate ratio, how much profit you make, right? But in actual trading, if today we deal about psychology and managing our emotions throughout our journey, you need to understand this term here called expected value. Okay. Now, a lot of times people only focus on win rate, probability, right? Often I hear people ask, oh, what's your accuracy of the strategy? Okay. How accurate can this strategy be? Okay. Now, it's important, but this doesn't show you everything. Okay. Now, what I mean is that you need to understand the whole equation that constitute to a strategy being profitable. Okay, And that formula is what we call expected value, EV. Now, expected value has a formula like this, right? It's basically equal to the probability of win multiplied by the probability by the average wins that you have, plus the probability of the loss multiplied by the average of losses. Okay, now so from this equation itself, right, you can see it's not just about the win rate ratio, it's not just about your accuracy, but it's also about your average win and your average loss. Okay, and the whole idea here is that based on this formula, if your EV is a positive number, it is a profitable strategy. Okay, if your EV, of course, is a negative number, then it's a losing strategy. Okay, which means you probably need to do fine tuning and things like that. Okay, now to give you an example, okay, of how this is being applied. Now let's say we flip a coin, okay, and we know roughly if you flip it sufficiently in a neutral way, we have a 50% chance of getting hit, 50% chance of getting killed. Okay, so we have a neutral coin, we flip it normally. Over time, we flip it, with sufficient number, then we know that the stats is going to be around 50-50. Okay. Now let's say we add in a little bit, right, of averages wins and averages losses. Okay, so if let's say if we flip a head, we average win is about 1.5%, or let's say $150. Okay, and every time we flip tail, we lose about $100. Okay, so if we start to input this into the formula, so we get an EV equals to 0.5 with a 50% multiplied by average win, which is 150. Okay, plus 0.5 minus, sorry, that's not minus, times, right, a negative 100, because we are losing on that, right? So if you start to calculate that, the formula tells us that the EV is $25. Okay, so what does this mean? It means that the expected value of this strategy, this method, okay, of just flipping coin, and then if you win, you win 150, if you lose 100, will give you an average return per flip of about $25. Now, because the expected value is positive, okay, what would you do? You will keep flipping the coin, keep continuing to use this strategy until the EV turns negative. So as long as the EV is positive, what would you do? You just keep flipping the coin, right? You don't care every outcome that comes out, you just keep flipping it. Okay, because over time, the course of the positive EV is a profitable one. Okay, now it's easier said than done, right? Because right now it's very statistical, it's very mathematical. There's no emotion involved. Okay, but of course, when you're trading, when you're investing, there will be that effect of emotion and psychology kicking in. Okay, I just want you to know that you need to at least understand your strategy in this perspective. Okay? Not just about probability, but in terms of expected value. Because if today you have a positive expected value strategy, then you would have a very strong confidence and conviction in your strategy in such a way that even if you hit, let's say, a consecutive 5 times losses, okay, you will not be overly worried, because why? You know this strategy has a positive EV. The individual trade outcome is not that significant as compared to my strategy's expected value. You will have that confidence, you will have that conviction to keep discipline, keep yourself disciplined, and keep executing the trade, because you know that EV value is positive. So this is why it's important, right? We don't really care the outcome of each trade. What we want to do is we focus on knowing that this strategy is eventually going to be profitable. We focus on executing it. Okay, so that's the idea of understanding EV. Okay? So don't just focus on the probability of your trade, focus on the expected value, because a high probability win rate can be a losing strategy. Okay, a low probability win rate can be a profitable strategy. Okay, so get that into your head. Now, of course, you also need to understand what we mean by market cycle, because every strategy itself will have what we call a winning streak and a losing streak. That's normal. If you today tell me that your strategy will going to give you a very fixed outcome, like win win lose, win win lose, win win lose, it's not going to happen. Okay, so every outcome of your trade in the market is going to be random. Okay, but if you have sufficient statistics, then it becomes what we call an organized chaos, and then from there you'll be able to study it. Okay, so I want you to know that every strategy will have winning and losing streaks, right? Depending on, of course, the market condition, the market environment, whether your strategy is more designed for maybe a range bound environment or your strategy is designed for a trend environment. Okay, so what we want to then take note of is we want to be mentally prepared. Okay, at least plan out what's the worst case scenario that we are willing to accept, right? And in this case, your worst case scenario, of course, it means that we are talking about losing streak over here. Okay, so you need to also then understand what is your comfortable maximum drawdown. Okay, the idea of maximum drawdown is that when you're suffering a losing streak, okay, you keep losing, you keep losing, you keep losing, your capital is going to be tanking, right? And the idea of maximum drawdown is as you keep losing money in each trade, okay, your capital starts to get smaller and smaller and smaller. What is the baseline in which you're being comfortable? That means, at a certain point in time, you must say that, okay, that's sufficient. I cannot lose anymore. That's my limit. And therefore, that's what we call maximum drawdown. Okay, every trader investor is different. Okay, all of us have different risk profile as well. But to give you an example, right, if today you have, let's say, 100,000 capital, okay, you start trading investing, and let's say you're suffering a losing streak, okay, and your 100,000 drops to, let's say, 90,000. So that's actually a 10% drop, right? That's a $10,000 out of $100,000 loss. So that's a 10% drawdown. Okay, so some might be okay with 10%, some might be, not that okay with 10%. There's no right answer, but you need to know what is your maximum comfort level for drawdown. So next statistics you need to know is what's your worst losing streak based on your strategy and the method that you're using. Okay, based on historically, of course. Okay. Now, when you have these two information, that's where it will help you in your trading journey by managing risks, by understanding the cycle. Okay? So you can better prepare mentally to handle the worst case scenario. Okay, so give you some example, right? Now, if you know that your method and strategy, the worst streak is, let's say, 10 consecutive losses. Okay, and you know that psychologically the maximum drawdown that you can take is 20%. Okay? So if you have this two information, that is fairly easy to manage your risk, because with this you can know that, okay, the worst losing streak that I experienced based on this strategy in the past is 10 times, okay, 10 consecutive losses, and my worst drawdown that I'm prepared to take is 20%. Okay, so what you do is you take 20%, divide by 10, that gives you a maximum risk per trade of 2%. Now, in other words, every time you enter a trade, the max risk you're going to put is 2%. Okay, why? Because based on your method, based on your strategy, the worst case is you're going to suffer 10 losses. Okay, 10 straight losses. Now, if you put 2% risk per trade and you suffer 10 consecutive losses, what is going to happen? It's going to hit your maximum drawdown. You're not going to lose everything. You're just going to hit your maximum comfort level. Okay, so if you even want to put a little bit of buffer, you can of course play around with these numbers over here to be even safer and more conservative. Okay, but I want you to see like how safe trading can be if you understand all this element and you manage it well with discipline. Okay, what's the worst case? The worst case is it hits your maximum drawdown, right? So that is what managing risk really means. Okay, and if today you're able to do all these things, I'm pretty sure your psychology and your emotions will be way well managed as compared to another trader who doesn't understand any of this. Okay, so here are some little tricks and techniques that might be helpful, okay, to help you manage a little bit of your risk. Now, the first technique here is called logic stop technique. Okay, now logic stop technique, the idea over here is, whenever you feel emotional, okay, you don't want to reject it off. You just want to first accept, acknowledge it, okay, and then you start to stop. Okay, that's why it's logic stop. So you pause. Okay, if let's say today the S&P market is tanking, you feel worried, you feel anxious, you feel angry, whatever it is, okay, acknowledge that, right? Agree and tell yourself, yeah, I'm feeling that. Pause for a moment. Find out why you're feeling this. Okay, are you feeling anxious, worried because you have no idea what's happening? Okay, you do not know what's next. You are worried, like, should I cut? Should I not cut? Should I add on position? What should I do? Right? If you realize that, oh, I'm feeling anxious because I do not know what to do, you found out the cause. Okay, it's not the market, right? It's because you do not know what to do. Okay, or let's say you are feeling angry or you are feeling disappointed because you feel that, maybe I don't you tell your friend that, whoa, this year the market is gonna go up, but then the market came down in January, right? And you feel angry, you feel disappointed because you told your friend otherwise, but it happens the opposite, and then you feel maybe shame, right? Maybe that's the reason. So many of these reasons here can be, beyond monetary, okay, or it can be maybe monetary, okay. So all of us are different, okay. So just sharing with you like some of the potential causes, right? So you want to think and figure it out, okay. Now, why is this important? Because once you're able to identify the root cause, you can then start to fill in the gap, okay, and manage that barrier in the future. That's the whole idea of it, okay. So this logic stop technique is very, very powerful. Now, the other technique you can use is, we call it the time gap technique. Now, the idea here is whenever you feel emotional, just avoid making any decision. Okay, so for example, right, the market is tanking last week, you're feeling fearful, okay, and then you are thinking, okay, should I exit my position, close off everything, okay, realize the loss, or should I add on more position, okay, to scale down? What should I do? Okay, now if you're feeling emotional and you're not able to think logically, don't do anything yet. Maybe give yourself, like as I mentioned, if Friday you're feeling it, then at least over the weekend when the market is not moving, you have sufficient time to cool down, think. Okay, think in a very objective and rational way. What should you be doing, right? Actually, you shouldn't be using too much time, because you should have a proper trade plan, investment thesis, right? Your trade plan, your strategy, your investment thesis should tell you what exactly you should be doing when the market is coming down like that. All right, so this is the time gap technique. Okay? Give yourself some time, even a day's time, to think what you should be doing. Now, the third technique is called a separation technique. Now, this is easy, said than done. Okay, but it's also a very powerful technique. Okay, now I want you to understand that you need to separate yourself from the market. Okay, and I have this quote over here, right? We are not the market isn't us. Okay, what this exactly means is that whatever outcome of the trade is, we can't really control it. Okay, there are certain elements we can control, but not everything. Okay, we can control how we get in, we can control when we get out, we can control the size that we put in, we can control risk, right? We can control how we manage, but we can never control whether the market is going to go up or come down, right? We can't control that. So you need to also understand that whatever the outcome of the trade is, it's not fully the cause of us. Okay, we can do certain things to manage it, but whatever outcome it is, it's not entirely up to us. Okay, so you need to have this little bit of perspective here. Okay, now, because if today you start to feel that you're very lousy, you start to beat up yourself too much, you start to think that, well, whatever I do, the market is always against me. When you're feeling all these emotions, okay, you want to use this technique, separation technique. Tell yourself, we are not the market isn't us. Okay, so whether is it going to be a winning or a losing trade, it doesn't directly reflect us as an individual. Okay, so if you're suffering a losing trade in the market, it does not mean that you are a very lousy person. Okay, it just means that perhaps the strategy right now is not that effective. Okay, then as a person, as a trader, what you want to do, you want to start looking out for how can you improve the strategy, what other strategy is more effective. Okay, that's nothing to do with you as an individual. Okay, so this is what we call the separation technique. It's actually a skill, a method to protect your mental capital. Okay, so the worst thing you can do is you go and beat yourself up, and the whole vicious cycle is going to crumble. Yeah, so I hope so far so good. Great. So we have this. This is probably the next repeat, right? Okay, good. So I hope today's sharing over here does give you that little perspective, in terms of like how you can manage your trading and investing psychology. And this is so important because especially with what's happening in the equities market right now, okay, many retail investors who are in the stock market is gonna feel painful. Okay, I hope this little topic here that we cover was way before all this happened, so that you can manage it when it's happening. Okay, but of course we can never know exactly when the market is coming down and things like that. And sharing over here is always already scheduled. Yeah, so it's better now than in the future. But I hope today's sharing here can give you some insights into how to better approach trading and investing, not just from a strategy, from the methodology point of view, but from a psychological and mental capital point of view. Okay, now this is so important that I cannot stretch it enough. Okay, where a lot of people out there do not talk about it. It's not a very sexy topic, but it's a very important element to determine whether you're going to be successful in trading in the long run. Okay, so I hope today's sharing helps. Okay, and of course, let's see how the market develop from here. And for those of you who are trading, okay, do apply some of these principles that we talk about today. And but of course, right, I always say manage your risk well. Nothing really can happen to you as a trader investor. Okay, so good. That's all from me for today. With that, we'll end off today's sharing over here, and I'll see you guys in the next session. Okay, see you guys. Bye bye.